Thanks so much for staying with us. We've got a lot more economic analysis coming right up. On our set for a discussion on the volatility in financial markets, we have Eran Peleg, Chief Investment Officer, Clarity Capital. Thank you as ever very much for being with us.
Pleasure to be here.
Well, tell us the financial volatility that we've seen since the start of this year. What's behind it?
So we're really seeing a tug of war between two main conflicting forces. On one hand, fundamentals are weak. Economic growth is slowing down. Growth is being downgraded. Only yesterday did we get the IMF come out and downgrade their growth forecast for 2016 again to 3.2%. The U.S. has been, growing at less than 2% in the fourth quarter of last year, and seems like it will be similar pace in Q1 for this year. So corporate earnings are fairly weak, negative year-on-year now in the U.S. So on one hand, those weak fundamentals. On the other hand, monetary injections by both central banks and corporations that are buying back their shares are supporting markets to some extent. So at times we have one of these forces dominate, at other times we have the other, and that kind of results in this roller coaster ride that we've really experienced over the last couple of months.
Well, for months as well, we've been hearing repeatedly from analysts and policymakers alike concern about China. How much of it contributing to this turmoil?
So China, it's true that there were a lot of concerns about China over the last couple of months, especially if you remember in the previous summer of 2015, it was kind of in the focus of investments and investors. The truth is, I think that China, the concerns over China have eased somewhat recently. It actually seems that things may have stabilized. People were concerned that China might be heading for a hard landing and kind of pulling down the rest of the world with us. And it seems that some of the actions taken both on the fiscal side and on the monetary side by the authorities in China may be bearing some fruits now, which have led to some stabilization and easing of concerns there. So I don't think China is at the center of this at the moment.
Interestingly enough as well, gold, one of the best performing assets, does that reflect this macro market uncertainty that we're seeing?
So it's true, gold has performed very well this year. Since the beginning of the year, it's up more than 15%, quite extraordinary relative to everything else. Gold definitely is seen as a safe haven in times of kind of macro uncertainty, and that's helped. But the additional factors have also contributing here. Gold is very sensitive to interest rate expectations. Because gold doesn't, pay a dividend, or there's no interest on gold, very, very sensitive to the opportunity cost of holding gold, which is really interest rates. So as interest rate expectations have come down as a result of, growth slowing, then gold, that has supported gold as well. And finally, gold is often seen as an alternative currency as well. We're in a world of weak growth. Again, countries are doing whatever they can to stimulate growth. One of the ways that they can do that is by devaluing or putting pressure on the currency for in the direction of devaluation. So everyone's trying to devalue their currencies at the same time. This is what's sometimes called competitive devaluations. In that kind of world, gold is also seen as a store of value, because countries can print as much money as they want, theoretically at least, but they can't print gold. So the supply of gold is limited, and therefore it's seen as something that can preserve capital, preserve value.
All right. Well, one indeed rare resource here. Thank you so much for being with us, Eran Peleg.
Thank you very much.